to this week's Money Metals podcast, helping gold and silver investors during these turbulent times. Now, this week's market wrap with commentary and analysis from Money Metals Exchange, the company named Best Overall Precious Metals Dealer by Investopedia.
Welcome to this week's Market Wrap podcast. I'm Mike Gleason. Coming up, don't miss a wonderful interview with Frank Holmes, CEO of U.S. Global Investors and Executive Chairman of Hive Blockchain Technologies. Frank has some interesting things to say about de-dollarization and the geopolitical shifts that have impacted global trade, and also shares why he is still quite bullish on gold, despite the breather the yellow metal has taken over the past few months since it reached its $3,500 an ounce high. Frank also breaks down what he's seeing in terms of the supply and demand dynamics in the best-performing commodity of the year, that being platinum. So be sure to stick around for another terrific interview between Mike Maharrey and Frank Holmes coming up after this week's market update. As widely expected, the Federal Reserve maintained its wait-and-see position, taking no interest rate action during the recent July FOMC meeting. However, there were some evident cracks in the committee as two members dissented from the majority decision. It was the first time multiple committee members opposed the majority since late 1993. Until at least September, the federal funds rate will remain set between 4.25% and 4.5%. The messaging coming out of the meeting was similar to the mantra last month. Inflation remains somewhat elevated. The economy is still strong. We don't know the impact of tariffs. It's a time to wait and see. However, there was a subtle shift in the official FOMC statement that could be taken as more dovish. The committee said the, quote, growth of economic activity moderated in the first half of the year. The FOMC statement also said uncertainty about the economic outlook remains elevated. During his post-meeting press conference, Powell said the committee decided to hold its policy rate where it's been, which he characterized as, quote, moderately restrictive. Many market observers read this as a hawkish signal that the central bank may not cut in September either. Stocks took a dip in the wake of Powell's comments because markets seemed to think that Powell pushed back on a September rate cut. It's clear the majority of the FOMC remains worried about price inflation. Based on the CPI, price inflation heated up in June. Powell said that tariffs have begun to impact the prices of some goods, but claimed it is too early to determine their overall effect. Meanwhile, President Donald Trump has been pushing hard for rate cuts, and he took to social media to make his displeasure known, calling Jerome Powell a total loser who's harming the country. Now, for those of you scoring at home, a month ago, Trump merely called Powell a stupid person. So many of you, like me, may recognize that the recent insult upgrade of the Fed chairman now being called a, quote, total loser does represent a bit of a shift that we need to take note of. We'll be sure to keep you updated on any new developments or additional jabs or barbs the president may sling in Powell's direction in the coming weeks, so stay tuned. Now, looking at history, the current interest rate level isn't high at all. So why are so many people clamoring for rate cuts? Because decades of artificially low rates and multiple rounds of quantitative easing since the 2008 financial crisis have addicted the economy to easy money. Fed policy incentivized a borrowing spree, and the economy is loaded up with debt. A debt-riddled economy can't operate in an even modestly higher rate environment. On the other side of the coin, you have inflation. While the Federal Reserve tightened monetary policy enough to rein in rising prices, it never did enough to slay the inflation dragon. When you break down the Fed's messaging, it's clear they're torn between two worries. They know the economy is getting shaky, but they are also aware that inflation isn't dead. And what do you call high inflation coupled with low growth? Stagflation, a word we keep coming back to. It appears the plan is to stand pat and then address whatever side of the coin gets ugly first. If the CPI surges, rates will remain elevated. But if the economy begins to wobble, you can expect fast and aggressive cuts. The Fed's current inaction is exactly what you would expect given the catch-22 it finds itself in. It simultaneously needs to cut rates to prop up the easy money-addicted economy and hold rates steady or even raise them to keep inflation at bay. What is a central banker to do? Well, simply wait and see. And lastly, before we get to this week's interview, let's take a look at the weekly market action. Gold is rebounding here today after suffering a bit earlier in the week. A soft U.S. jobs report here on Friday buoyed gold, and it's now anticipated that it increases the possibility of a September rate cut. The yellow metal is now up about $5 or 0.15% on the week to trade at $3,355 an ounce as of this Friday late morning recording. Turning to the white metals, silver is having a bit of a rough week, having experienced a big midweek drop, but it has stabilized a bit, off now by $1.30 an ounce this week to check in at $37.06 an ounce and a 3.4% weekly decline. Platinum is off more than $100 this week and checks in at $1,318 an ounce, off 7.2% since last Friday's close. Palladium is down 3.9% and sits at $1,228. And finally, there has been some major fireworks in the copper market this week. The industrial metal, which was pushing up towards $6 a pound a week ago, is down 25% this week and currently trades at just $4.42. The news surrounding tariffs has greatly affected Dr. Copper, which fell 20% in a single day earlier this week. Well, now, without further delay, and for much more on the markets and the economy, let's get right to this week's exclusive interview.
Greetings, I'm Mike Maharrey, a reporter and analyst here at Money Metals, and I'm thrilled to be joined today by Frank Holmes. Frank is the CEO and Chief Investment Officer at U.S. Global Investors and the Executive Chairman of Hive Blockchain Technologies. How are you doing today?
Outstanding, my friend.
Well, I really appreciate you taking a little time. I know you're a busy man, and appreciate the opportunity to pick your brain a little bit and get some of your insights on things. Let's start off with gold. Feels like we're in a bit of a consolidation period after we hit that record high back in April. Kind of been trading sideways for the last couple of months. In your view, are we kind of gathering momentum for the next leg up, or do you think, as some people seem to think, that the yellow metal's run out of gas?
No, I think you're going to have the metaphor of a sailor out on the ocean, and it's a sunny day, but it's a windy day. So you just have to be tactful and tacking that sailboat as you navigate through the winds. Excuse me one second, Michael. Mm-hmm. And I think that's what we're dealing with. It's we've seen rates all of a sudden pick back up. They fell below their 50-day moving average, and now the 10 years come back up to touch it. Oil is slightly above it. So those factors sort of kick that lull, but I don't think it's going away. And it's probably like the Bitcoin ecosystem say, buy the dip and hold on for dear life. Stack those gold coins, stack those silver coins. And I think it's not just, they say Bitcoin, but I tell people silver coins and gold coins, stack them.
Yeah, I agree completely. You mentioned interest rates, and that's kind of something that's it's interesting to watch. As we're speaking today, this will air after the meeting is over, but as we're talking, the Fed has just kicked off its July meeting. Most people seem to think that they're going to hold rates steady and maybe signal some rate cuts in the future. I'm curious how you kind of see the interest rate trajectory playing out, because I kind of feel like that even if the Fed cuts, they may not have as much control as they might think they do, especially on the higher end of the curve. Do you see real interest rates going negative again, or are we kind of on a trajectory of a higher rate environment?
I don't think, they could easily go negative. I think they are actually negative. If you
right now,
the CPI number is FUD. That's a word I picked up from the Bitcoin ecosystem, where governments are making false and doubting statements, and the CPI basket is old. It's always old, and it's readjusted so that it doesn't really capture what you and I find. You just flew back from California, and those prices, those tickets are 100% higher than pre-COVID. So that means over 5 years that inflation's grown at 15% CAGR. the rule of 72. And when we look at eggs, and now Amazon just raised the prices for a lot of the smaller items by 30 to 100%. When they say inflation is running at 4 to 5%, that's just not true. And gold shrewd investors know that the better way is looking at purchasing power is declining at a roughly a 12% CAGR. That's the real rate. So I think that we're living right now, inflation is running at 12%. It's not running at 4 or 5. But according to how the capital markets are functioning, the CPI number is FUD in many countries. So we have to just deal with it. And that's another reason why the stock market making all-time highs. Gold makes all-time highs. It takes a breather. Bitcoin makes a new all-time high. It takes a breather. Stock market takes an all-time high. Why is that? Because the real assets, and when you look at the overall balance sheets of public companies, there's a lot less debt than there was prior to 2008. All that debt's gone. And so these are much more stable looking businesses, real assets. And I think that that's why, another reason why the stock market is doing what it's doing, because people actually want to own real assets.
That's a really good point. I've pointed out often, anytime I talk about the CPI, I mention the fact that, even looking back at the formula that they used in the 70s, they revised that in the 90s. And if you run the numbers through the 70s formula, you'll find that price inflation is about double of what they're reporting. So I think that's a really, really good point that is lost on a lot of people. Let's talk a little bit about platinum. You wrote an article recently and pointed out the fact that platinum was actually the best performing commodity in H1. It was up, I think, 49+%, almost 50%, even outperforming gold. Is this something that you think is kind of a trend that is growing, or was it just some type of anomaly? What's driving this run up in platinum right now?
Well, I think it's the industrial use has grown, and I think the supply has not been expanding unless you're recycling platinum. And if you look at economies in Asia, in particular, when they buy diamonds, they prefer silver color, and platinum doesn't tarnish like silver does. So they have a lot of their jewelry is reflection off of diamonds on a platinum ring, on a platinum bracelet, on a platinum. So that relates to the GDP per capita, and the rising GDP per capita in China and Japan and South Korea, in particular China, Vietnam, Malaysia, it's been stronger than the US, the GDP per capita. And the correlation for that love trade is very high to rising GDP per capita.
That's interesting. My wife's a big fan of platinum jewelry, so I totally get that. Do you think that the supply can catch up? I mean, we've seen a significant run up in prices. A lot of times you'll see supply and demand respond to that. Is that something that could happen with platinum?
No, I don't see that, because the platinum mines that are in existence are deep. And there's been a slowdown in exploration and development. We have seen South Africa as a nation go so what was it? Hysteria over anti-mining regulations. So the country as a whole has not been attracting the capital necessary for exploration development of resources. And then we look at palladium, which is sort of connected to platinum. It predominantly comes out of Russia. And as we all know, the problems in Russia, it creates sort of a dysfunctional part of finding more reserves.
Yeah, and I think people forget too. It takes a while. I mean, even if when prices go up, we're seeing this with the gold supply as well. Prices can go up, but it takes a long time to ramp up a mining operation, to find new reserves, and to increase research and all of those things that are necessary. So it's kind of an inelastic relationship in terms of price.
It's so true, Mike. And I'll give you a real simple data point. When I first started in this business, and I'm 70 years old, world. And I joined in Toronto a brokerage firm as a research analyst in 1978. And Pierre Lassonde, a couple of years later, wrote a book, and it became well known as the Lassonde cycle, the life cycle of a mine. And there's three major stages, and you have the big run up on the exploration discovery, you have a correction, and then you have a sideways movement in development, and then you have going into production. Well, that cycle used to be 7 years. It's now 30.
Wow.
So Pierre Lassonde was commenting about this at the Denver Gold Show, that in many nations, all these regulations and rules have extended it, except for countries like China. They can find, explore, develop something much more readily. And they've also become very dominant in Latin America and Africa and fast tracking. So they go and get a fast tracking permit if they're going to develop the mine, because they're going to build the railway to the port. And they have this policy called One Road, One Belt. And it was supposed to be the Marco Polo belt, but really underneath the hood, it's a communist belt. And slowly you start to see that there's a favoritism of the countries that they've worked with are monarchs or they're dictators. It's anything to undermine democracy, as you see around the world, is what this sort of policy has been under Xi Jinping, who's a communist and hardcore, very smart Machiavellian. And so we see these sort of shifts in the commodities where they're trying to get control of all the commodities. So like they've wrestled and been able to get control of strategic minerals, buying a big buyer of gold. Well, they're a buyer of gold because their currency doesn't have the legitimacy. So they continue to say that we have more gold backing our currencies, therefore you should take our gold and replace the US dollar. They attack it with de-dollarization, and they've now accelerated that with the BRICS nations, and more countries are going underneath the umbrella of the BRICS nations to only trade. All this stuff is interesting to me. It's really hurt on trade Europe. Because if Saudi Arabia sells them oil and they take Wong, they immediately convert it to US dollars. And so, in fact, US dollar trade has gone up. But this attack and trying to de-dollarize, it's going to continue to grow, with Russia and China being the big sort of catalyst for that.
I'm glad you mentioned de-dollarization, because that's something that I wanted to touch on as we talked. Another article that you put out not too long ago talked about the dollar becoming more, I think you called it unattractive. And kind of what do you mean by that? I mean, what are we seeing in practical terms with the dollar right now?
Well, the dollar becomes unattractive with a huge deficit spending on that relative basis. And the offset of that is the huge spend on defense and to protect against the predatory practices of Russia, China. We know that North Korea has soldiers fighting for Russia and Ukraine. Why? Because if Ukraine falls, then North Korea to invade South Korea, China to invade Taiwan. We see this sort of domino effect. And I think that that's the concern. On one hand, the dollar has all this money printing and has a huge deficit. So that doesn't make it so attractive. But on the other hand, the dollar is attractive because it has the strongest military behind it. It is the most fungible paper currency in the world. And I think what America's done last week is what's called the Genius Act. And the Genius Act is going to usher in stable coins, which really are like money market funds that don't pay a yield, but they're US dollars for foreigners to own US dollars outside of their banking system and their countries, because countries like Argentina confiscated all the US bank accounts. So then we've seen the stable coin of Tether grow to be the highest revenue producing company in the world. 175 people, that's all, Michael. And they made 13 billion. And because they keep the yield on the treasuries they're buying, they have more U.S. treasuries than Germany does. That Tether has 300 million customers' wallets that people want to have U.S. dollars, on average 4,000 U.S. dollars in cyberspace to protect themselves. That psychology. So we know the world wants US dollars, and now it's going to be able to come in cash, or it's going to be coming in a digital format. That's part of the strategy of battling the de-dollarization by the BRICS nations. That this is my opinion. The same looking at global strategies. I think that the biggest thing when we say the dollar is not attractive, it's because of this deficit spending. But now we're starting to see in the past week, big numbers coming up with China, with their M1, how it's exploding 4%, and it's growing, and the sheer size of it, and the money printing taking place in other nations. So I think it's like a race to devalue the currency, and the US dollar will probably be devaluing the least because the rest will all catch up. This tariff spat and tariff war was an incredible strategy on April the 2nd to declare war on everyone, tariff war. But really, the war was on China. So rather than single out China, it was, okay, Canada, you get 6 months. Each country was renegotiating. So now we had the EU this week is settled at 15%, no tariffs for American goods going there. It wasn't 30%. China still is, the sentiment has improved, but the exact terms have not been finalized. So that's helped rebound the dollar. The dollar is now rebounded back to the 50-day moving average. So we're witnessing a lot of sentiment besides the negative real interest rates scenario. And I think that all this is like Ray Dalio said this week, that you should have 15% in gold and Bitcoin now as a way to diversify against all this money printing globally.
Yeah, that absolutely makes sense. Do you see any off ramp with the deficits and the debt? I mean, I don't see much intention to really address the spending problems. Do you have any optimism that they can work that out somehow?
No, I don't see it. It's not going to happen. And they're going to today make the big push on military spending. When we look at Chinese military spending, only 10% of their budget is really for the soldiers. In America, 50% is for healthcare and soldiers. And so when we look at the exponential growth, they now have more ships and destroyers than America does on the ocean. We're much more advanced when it comes to military aircraft, and we're more advanced with aircraft carriers, but they have more military ships. And so we're going to witness what Trump did. It shocked everyone in Canada. But with the positive part is he had the Canadians all of a sudden wake up with an identity, and they're all wrapping themselves in the flag. And that brought in a new prime minister who was the head of a central bank and who was with Goldman Sachs and was the chairman of Brookfield, is much more business orientated. And they've taken their military budget from 25 billion to 150 billion. Germany is going to put 5% of their GDP. Well, how big is Germany? Well, it's the 5th biggest economy in the world. That is a big number. $250 billion is going to go into military spending. And you see all the military stocks in Germany double in 3 months, double. And so we're seeing job creation by governments going into cybersecurity protection, borders protection. We're seeing this sort of a complete 180 from President Biden of open borders. Same thing as the concept with Canada and Europe, open borders. Well, no, even the Catholic Church locks down the churches at nighttime. You have to lock down your border and protect. And so I think that paradigm shift is happening as we see it, and we're going to see more money going into AI and data centers for military security, not for invading, but to protect democracies. So you're really witnessing the democratic nations of the world are going to spend much more money on national security.
Yeah, it's really interesting the way the geopolitical dynamics seem to have shifted very quickly in the last year or so, and it'll be interesting to see how that continues to play out. When we talk about de-dollarization, and let's just assume that it continues in that on a de-dollarization trajectory, what would be the ramifications of that?
Well, it would have a big impact on inflation, but it would also on trade. The dollar facilitates a freer mechanism for trading, but the real backlash happened when the State Department went after all the Russian oligarchs and Putin and froze $300 billion. So that really escalated. These other nations said, we've got to protect our money from America's aggressive State Department, but it was a response to Ukraine being invaded. And so we've seen now the KGB type of mindset of Putin was polluting through NGOs, everyone in Europe to shut down nuclear energy. Why? Because he wanted them all to buy Russian gas. It was a natural. And so therefore the protests, and Germany shut down all their nuclear reactors, and then the invasion, and then all of a sudden their gas is gone. And now they're burning coal greater than they were 5 years ago. So we're just witnessing this sort of swing of policies of being testing new open border type of concepts and only green. And then now we're coming back to saying, no, we have to be moderate. We have to be in the middle. We saw this in Spain 2 months ago with huge blackouts. Why? Because the leadership was so caught up with we can only be green, wind and solar. Well, the problem with wind and solar only is that it really functions during the day. At nighttime, it doesn't. The winds change, the sun is gone, you need big battery storage, and you need energy to move the energy along the power lines. So when you have hydroelectricity, the water is always flowing, then you always have electricity. We have nuclear, the energy is always flowing. So they shut down the ability to flow the energy, and the ramifications were these big blackouts.
Yeah.
And so I think there's also a backlash of these NGOs. I call them not good organizations, and they have impacted Canada. I know that growing up there and seeing the difference, and a much more significant impact on policies in Europe. And I think it's going to change now.
Yeah, it's interesting. I know that I have some family that was involved with some of the U.S. NGOs that were funded through U.S. aid, and it's amazing how quickly that whole environment has shifted with the new administration and the budget cutting and whatnot. And I think that will definitely have some ramifications as we kind of roll downhill from that. But I was surprised how quickly that shift happened.
Yeah, and I was really surprised when a friend of mine was saying that, oh yeah, he got cut for $15 million a year. I said, what do you mean? You're in Canada and you have an NGO and the U.S. government's funding it? I said, that's my tax dollars. And what are you paying your CEO? $500,000 a year. That's big money. And so I'm happy to see that it's holding these NGOs accountable for different level. The sad part is there's some really, truly good NGOs, and there's some really good compassion to help people in these other poor nations. And they all of a sudden, they get hurt too with this whole accountability policy.
Yeah, that's the problem with government stuff in general. I think it tends to operate with a very large, blunt instrument, and the good and the bad. Sometimes it's hard to untangle all of that. The way the government incentives work. But you're right; it definitely has impacted a lot of decent organizations as well. Let me get you out on this one. I was kind of looking at the gold demand, and especially as we were looking kind of through the big rally with gold through the first quarter of this year, and you see a lot of really strong, especially in physical investment in Asia, China, India. A lot of U.S. investors haven't gotten on the bandwagon. And I know from talking to folks that are on the business side here at Money Metals, we've actually seen a lot of selling of both gold and silver. Why do you think there's that kind of dichotomy between East and West right now? Do you think the Western investors are going to finally start jumping on the gold and silver bandwagon?
It's a great question because we've seen that with gold stocks. If you look at GDX and GDXJ, billions of dollars have been redeemed as gold stocks have made all-time highs. and billions made. And if we look at gold stocks today, Newmont, the analysts covering Newmont, not one was close to how it blew away earnings. So they're so negative. So I've signed that with my airlines, my Jets ETF. The world of flying and tourism business has changed dramatically. There's what's called digital nomads. There's almost 50 million people that do their coding or do their strategy and their research in different climates. They go north, south predominantly, and they occupy all these planes. If they're doing 4 extra flights a year, well, the planes haven't increased that enough. The airports haven't increased enough to deal with this other demand, and people don't want to be stuck at home. What the analysts in Wall Street keep always saying, they're always negative. They want to look for something that's negative. There's not one analyst that called United Airlines to go up 30% last year, and it only went up 130%. There's not one that's talked about Newmont earnings are going to blow it out. The free cash flow is going to explode, and that's what they announced this week. And so you're seeing a negative narrative on cyclical assets like gold, like airlines industry, by analysts betting that it's just going to be a contraction and not realizing the supply of gold is morphed. There's not a big supply of gold, and the adoption of gold will grow. But who's buying it are family offices and hedge funds. And so we do see that they're the ones coming in to buy the asset class. But it is, I know for our gold ETF, we've not experienced all these redemptions, maybe because we're a smart beta 2.0 and we have the royalty companies, we have a quant approach, and we've outperformed. But I think that it's just something you realize that the markets against cyclical asset classes really are going to come in late in the game. So I think that when I look at ratios of gold and gold stocks for the S&P 500, I look at, everyone likes the gold silver one, but you can also look at copper. The mining cycle is definitely going to be, has much more opportunity on the upside than the downside, and the risk is not to be long. I mean, how does Investors Business Daily has a quant approach, CAN-SLIM model of picking growth stocks. They predominantly catch all the growth stocks early. They got NVIDIA early. This is what they look for: price momentum with revenue and earnings momentum. Well, last quarter, 12 out of the 50 stocks were gold miners. And the ETF out there are getting redemptions. Doesn't make sense. And so I think by the time they wake up to that paradigm, then you'll get that big piling coming.
It was really interesting when I was reading your article about platinum. You have a really neat chart that shows like commodities that are listed in almost like a periodic table. And right. The top ones for this year so far are all in the precious metals. So you had platinum, gold, silver, then I think it went down to palladium and copper. So you see all of these. Copper's not really a precious metal so much, but it's really interesting looking at that. Folks should check that out because I think it kind of emphasizes.
But copper has its conductivity, and that's what's really important. It has a bigger industrial base than silver. And what we're seeing with particular the copper is what President Trump pushing for, developing the copper mines in America. That's great, but he's got to fast track the EPA's process for developing those resources for the copper mines. And I think that Robert Freeland was brilliant. 10 years ago, he started buying all these copper gold tracts of land in America that people basically ignored. And he was paying a penny for something that's trading at worth $8 a pound. He's paying a penny. And he kept stacking these assets. And now we're getting into that cycle because China would love to be able to shut off copper coming from Chile and Peru and from the Congo, that it only goes to China. It doesn't come to America like they've tried to do with strategic minerals. And that war for metals and commodities is not going away. It's just a part of a big cycle we're living through.
Very, very interesting. Well, where can folks go to follow your work? I mentioned a couple of articles. Where can folks find the stuff that you're doing and delve into the knowledge that you provide?
Well, usfunds.com. Sign up for Frank Talk and Investor Alert. But Frank Talk, my investment team, we publish every week. I write a piece on my global travels or something unique I see out there. And I think it's just helpful because I have 100,000 readers in 80 countries. We do a SWOT analysis that is 3 sentences, 3 strengths and weaknesses that impacted, say, gold last week, and what economic data is coming out next week, which could be an opportunity or threat for gold. So we like to keep it like professional game sports. How'd you play last week? Who are you going to play next week? And we fine tune that. And that's why people like it to sort of, in particular, to look at what's coming up next week. And so usfunds.com.
Excellent. Well, go visit that, ladies and gentlemen, and I think you'll find some great information. Frank, you're fantastic. I always appreciate your analysis. You always say things I don't exactly expect, which is cool. And so I really appreciate you taking the time out of your day and joining us, and we would certainly love to have you back on the show sometime in the relatively near future.
Great. Well, stay bullish, stay healthy.
Absolutely. You do the same. Thank you.
Cheers.
Well, I hope you enjoyed that interview, and that will do it for this week. Be sure to check back next Friday for our next weekly Market Wrap podcast. Check out the Money Metals midweek memo as well. To listen to any of our audio programs, just go to moneymetals.com/podcasts or find them on places like Apple Podcasts, Spotify, or other podcast platforms. And as a reminder and a big help to us, we ask that you would please like, subscribe, download, and rate our podcasts. Doing so helps us extend the reach of this material. Until next time, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a wonderful weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week, and don't forget to subscribe to our podcast through iTunes. For answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds, call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by to answer your call during business hours, Monday through Saturday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.